If Europe and rising oil are making you worried about stocks, well, you're going to want to pay attention to this one, this chart attack. You ready? Michael Gayed, he's back with us. His mic's working this time, we promise. Michael of Pension Partners. All right, Michael, tell us about this chart and what we're looking at and why it matters.
Okay, so this is a price ratio chart of the XRT Retailers ETF divided by the S&P 500. Now, focus less on the actual ratio, focus more on the trend. Here's what I want to stress.
Which is clearly up and has been for a long time.
An uptrend in a price ratio means that the numerator, XRT, retailers, are outperforming, up more or down less than the S&P. We're told every day that oil is a problem. We're told every day to be afraid of what's going on in the Middle East. We're told every day to be afraid about Europe. But wait a minute, none of that's consistent with the performance of retailers. Consumers continue to make new all-time highs.
In spite of high-priced gas, people are out there spending money at the retailers.
And that's a very important point. And historically, retailers tend to lead the broader stock market. What that means is that when they begin to outperform, the stock market follows. The fact that we're seeing new highs in retailers on an absolute and relative basis is a very bullish signal for the overall market and economy.
All right. Now, you pointed this out earlier to us, and this is amazing, guys. If we can just overlay now the S&P 500 with this chart, which I think we're going to show in white. Look at that. In other words, we had the bottom. I'm going to come over here just so everyone can see this. All right, here's the bottom in the ratio that Michael's talking about. And then 4 months later, you had the bottom in the S&P 500. In other words, the retailers started going up before the rest of the market.
Right. And if you take yourself back in time to that period when it looked like the end of the world was here, retailers were actually doing much better than a declining stock market. If it was the end of the world back then, how could retailers, how could consumer stocks be doing so well? So there is a leading effect there. And also it happened before in the late September when I started writing about the fall melt-up.
And by the same token, if we see the retailers over the next few months or a year, whatever, start to turn down before the S&P, that's our signal to sell.
That's a warning sign that things like oil may actually be having a negative impact as opposed to this feeling that it's having a negative impact now. When you start seeing it in price, that's when you should be afraid.
But so far, so good. The retailers are still going up. The index is going up.
That's correct.
All right, Michael Gayed, Chief Investment Strategy over at Pension Partners. That is a great insight.
Appreciate it.
You have just taken away the title of Ratio Man from one of our other guests. He's going to have to fight me for it. CJ over at Phoenix Partners, a new Ratio Man. All right, Michael Gayed.